Mr. President, I rise this afternoon to address the CRA that we voted to proceed to and which we will vote on final passage tomorrow. It is a Congressional Review Act that will allow us to repeal an ill-conceived CFPB regulation. And let me start with just a word about the CFPB, because this is an agency that is fundamentally flawed in its design, has been from day one. First, it's a single individual director. There's no bipartisan commission, there's no board, there's no need for consensus, there's one-man rules. Secondly, this one individual can only be removed for cause. He's part of the executive branch, but the chief executive can't fire him. This makes no sense. And finally, the entire CFPB, this huge regulatory agency, is subject to no meaningful oversight. They are not dependent on Congress, the people's representatives, for taxpayer funding. They just draw whatever they want out of the Fed, which means the Fed has that much less to hand over to the Treasury. So an individual rather than a commission, no ability to remove except for cause, and not subject to appropriation. It's a recipe for a disaster, and that's just what we've had. It's not just my opinion, by the way. A three-judge panel of the D.C. Circuit Court of Appeals ruled that this structure is fundamentally unconstitutional. I will quote briefly from their decision. They said, and I quote, "The CFPB's concentration of enormous executive power in a single, unaccountable, unchecked director not only departs from settled historical practice, but also poses a far greater risk of arbitrary decision-making and abuse of power, and a far greater threat to individual liberty than does a multi-member independent agency." Now, fortunately, we have an acting director at the moment who gets this. Mick Mulvaney has testified about these very flaws in the CFPB and suggested, as many of us have had, at least some structural reforms making the CFPB subject to appropriation so that Congress has meaningful oversight, requiring that the major rules that they pass be subject to a legislative approval, which is Congress taking responsibility for the action Congress delegates, giving the president the ability to hire and fire a director, and having an independent inspector general so that we have a watchdog. These are the least things that we should do, but our colleagues on the other side have not been willing to agree to any of them, and so we have this badly flawed agency. And it shouldn't be surprising that a flawed structure leads to badly flawed policies, and that's why we're here discussing this CRA, Mr. President. It's about the indirect auto lending guidance, as it's called, that the CFPB issued some time ago. Let me explain a little bit about what this is. So, indirect auto lending, what is that? Well, direct auto lending is what you might think. It's when a consumer, a buyer, someone who wants to buy a car, goes to a bank and lines up financing from the bank. That would be direct auto financing. Indirect auto financing is when the car dealer provides the arrangement of the financing for you. So the actual financing is ultimately performed by a lending institution, but the car dealer makes the arrangements. Well, indirect auto loans are actually very good for consumers for a variety of reasons. Number one, it's very convenient. You don't have to shop around to a bunch of banks as well as a bunch of car dealers. You get one-stop shopping and you have both. Secondly, there tends to be more competition for the consumer's loan. I mean, how many banks are you going to be able to realistically go out and visit when you are attempting to line up your financing? But the car dealer can routinely canvass all the available lending options and make sure that the consumer gets the best possible deal. And then finally, as a routine matter of practice, dealers have always been able to discount the loan as one of the negotiating provisions in a multi-part transaction. And that's an important thing to stress here. The nature of the car buying experience, for any of us who've done it, very typically there are several moving parts, several transactions. There is the purchase price you negotiate for the vehicle you're buying, the trade-in value for the vehicle you are parting with. There is the value of other services you may negotiate for. And it is not possible to judge the overall economics of a transaction like this unless you know all of the components. The interest rate you pay on the loan is but one of several important components. So along comes the CFPB in December of 2013. They issue a bulletin that is an attempt to regulate the indirect auto lending. And in this, they warned lenders of a disparate impact liability. So let me explain briefly what this means. So first of all, if lending policy is discriminatory, it's illegal. If the nature of the process, the documentation, the qualification, if there's discrimination on the basis of any protected class, and that would include race and sex and age and gender and other things, if it's discriminatory, it's illegal. What the CFPB came along and said is, even if the lending policy is not discriminatory, not on its face, it's non-discriminatory, you can still be liable for violation of the law if the CFPB thinks that there's a protected class, some category of people who are paying on average a higher interest rate on their loan. This is the disparate impact theory that the CFPB used in order to attempt to end the ability of auto dealers to discount loans as part of a negotiated transaction on a car purchase. So why is this so problematic? I'd say two categories. First is the very process by which the CFPB came up with this rule. First of all, it's actually a guidance, not a rulemaking. What does that mean? That means they chose not to follow the law, the Administrative Procedures Act, that requires an agency to go through a very systematic and public process of getting a lot of input and review on a proposed law, a proposed rule, before it goes into effect. For very good reason, we require regulators to get public input, to give experts and consumers and people engaged in the business the opportunity to examine the rule under consideration and provide some feedback as to whether there might be unforeseen consequences or flaws in it. They did none of this. The CFPB neither did they consult with the other regulators, as they're required by Dodd-Frank, nor did they do a cost-benefit analysis, which is also required by Dodd-Frank. And they surprised the industry and the consumers by fundamentally reinterpreting how the anti-discrimination legislation would be interpreted. Now, why did they do this? Why did they take this approach? Why did they circumvent the Administrative Procedures Act? Well, it's a convenient way to avoid scrutiny. It's a convenient way to be able to impose one's will without public scrutiny, without input, without any analysis. So this is a very bad process, and not surprisingly, the outcome is equally bad. Mr. President, the methodology they used to determine discrimination on the basis of race is really amazing, since there is no information about the race of a borrower in a financing for a vehicle. The lenders don't know the race of the borrowers, literally. They have no idea. Neither does the CFPB, but that didn't stop them from alleging racial discrimination. What they did was they developed a methodology, a system, where they attempt to guess the race of a car borrower, a car buyer who's financing the purchase of the car through a loan, and they try to guess the race based on the last name and geography. So they assign a probability to a person being African American or Hispanic or European American or whatever, based on a surname and geography. This is a wildly flawed process, which quite predictably led to huge errors. Independent outside analysis have concluded that their error rates could be as high as 40%. So 40% of the people that they would designate as African American, in fact, are not, or 40% of the people they would designate as European American, in fact, are not. But it's not just that they got their guesstimate wrong about race, but the manner in which they got it wrong led to the wrong and erroneous conclusion. In other words, there were systemic flaws that completely invalidated their conclusions. And finally, and maybe in some ways most importantly, they willfully chose to ignore all the other components of a transaction. They allege that someone was adversely impacted because they paid a higher rate of interest on a loan, but they have no idea what the purchase price on the vehicle was. They have no idea what the trade-in was for the used vehicle. They have no idea what other services were being offered. Well, this gets worse, Mr. President, because the CFPB decided they needed to make an example of someone so that they could terrorize the industry into ending this practice of discounting interest rates. And they found a good victim. Ally Bank was owned, about 74% was owned by the federal government at the time. They had an application before the Fed to change their corporate organization, which they needed to do. They needed to complete that, otherwise they would have to shed whole business lines. It's a long, complicated story. Suffice it to say that Ally Bank's future existence as it was formed depended on an approval from the Fed for what should have been a routine change in corporate structure. Well, the Fed made it clear they weren't going to grant that change until there was a settlement with the CFPB. So Ally Bank was over the barrel. That was exactly what the CFPB wanted. 5 days before the deadline, which would have required Ally Bank to divest itself of whole categories of business, the CFPB shakes them down for $100 million. 4 days later, the Fed approves the application. So the CFPB found its opportunity, made its example, and it had a chilling effect on the market. So let me just wrap this up, what we're talking about here. It's an unaccountable, out-of-control agency that circumvented the proper rulemaking process in order to avoid public scrutiny about what they were trying to do. They imposed their will on an industry that the Dodd-Frank legislation explicitly forbid them from regulating. They develop a badly flawed methodology to allege discrimination on the part of lenders on the basis of race, despite the fact that the lenders didn't know the race of the borrowers. They picked a victim who couldn't fight back. They hit the victim with a $100 million fine without the CFPB knowing that any individual was actually unfairly treated by Ally Bank. Didn't matter. Now, who ultimately pays the price for this kind of behavior, Mr. President? The very consumers that the CFPB is supposed to be serving. Under this very flawed rule of the CFPB, the goal was to effectively prevent auto dealers from being able to discount the interest rate on a loan, being unable to compete with a bank down the road that might be offering a lower rate, being unable to negotiate a term that might be helpful to a borrower. And so consumers, under the CFPB's rule, have fewer options, less flexibility, reduced access to credit, and higher costs. That's why Congress should overturn this, Mr. President. This is our opportunity to set this right. The House voted 332 to 96 to repeal this rule. We can do this tomorrow. Our colleagues on the other side of the aisle have complained about the use of the CRA in application to a guidance issue. Our Democratic colleagues themselves attempted to do this exact same thing with respect to a CHIP guidance that was issued some years ago, and they were perfectly okay with it then. I don't see why they can't be okay with it now. Important to note what this resolution does not do. It does not change in any way the legitimate enforcement of the Equal Credit Opportunity Act. It doesn't amend that act. It doesn't change Regulation B. And the enforcement of the Equal Credit Opportunity Act would simply continue as it had gone for 30-plus years. Discrimination in credit providing has been illegal, will continue to be illegal when we successfully pass this CRA. I want to thank Senator Moran and Will Reuter from his staff, John Cruz from my staff. I want to thank Terry Van Dorn from Leader McConnell's staff for his help, and urge my colleagues to vote in favor of this important Congressional Review Act. And I yield the floor.